We put together a couple slides, similar to the past, that we want to walk through to actually highlight what we're seeing in the opportunity set. The first thing that we've noticed is we want to take a step back and look at where we're sitting today for 2025 at the end of the year, and thinking about where valuations are for the marketplace in general. And the first slide that we have that we're going to put up is highlights the S&P 500 index. And I'll just kind of walk you through a little bit of discussion of where we are today in the valuation. That's looking back over the last 30 years. And if you thought about where the market has traded over that time period, we're sitting today at the higher end. We ended the year at 22 times. The average over the last 30 years is 17 times. And if we think about where prior peaks have been over the last 30 years, in 1999 and 2000 and 2021, were the only time periods in which you were higher than where we ended 2025. Also, if you think about from a CAPE or a cyclically adjusted PE multiple, which takes the current price divided by the average 10-year S&P 5 earnings, that actually ended looking at 2025 closer to 40 times. And you can see from this first chart on the left, we highlighted where the average of the, thinking about where the P multiple is, which is that dotted line, that's 17 times. And you can see where we ended the year in the prior peaks going back to 2000 and 2021. Today, if we looked over the past 3 years, the S&P multiple has expanded from 15 times to 22 times. Current market environment would be the opposite of 2009, looking at that chart, where valuation multiples contracted to a 30-year low, and S&P 500 margins were at trough levels due to the Great Recession. It's a little bit smaller. The chart on the right actually plots the 5-year annualized forward returns of the S&P 500 relative to the forward PE multiple. And as the PE multiple increases, the 5-year annualized returns fall, the inverse relationship between the two. At current valuation levels, you can basically see that the historic 5-year annualized forward returns are expected to be slightly positive and below long-term inflation. Back in 2009, again, when you had S&P 500 forward PE multiple back at 11 times, historical forward 5-year annualized returns on that chart highlight that they'd be closer to high teens from a historical perspective. It's also kind of worth noting, just overall from the market, we're ending the year at near peak margins. If you went back over the last 25 years, consensus expectations are for 14% earnings growth in 2026 versus a long-term average of high single digits. So again, we're setting the backdrop here where the market in general, the S&P 500 is at the higher end of historical valuation. If we turn to the next slide, it'll highlight what's been driving the market concentration. And it's been a significant outperformance if you were to think of looking at the top 10 from a weighting perspective. We're sitting today at the end of the year, basically where the top 10 moved up to 41%, up from 26% at the end of 2022. So that's an all-time high. And in 2000, the top 10 peaked at 27%. In 2021, it peaked near 31%. The green line on that left chart highlights the top 10's contribution to earnings. And if you look at where that ended the year, that's 800 basis points below. And even though we're at peak levels of earnings versus where we were going back to 2021, the market weight and cap weight of the top 10 is 800 basis points higher. So that's a large spread versus history. The chart on the right looks at equal weighted returns versus market cap of the S&P 500 index by year. The average stock in the S&P 500 lagged the overall index over the past 3 years by more than 25%, as you can see from the red box. That's a rare occurrence. You'd have to go back to the other dotted box of 1997 to 1999. We had a similar magnitude of that 3-year time period. The late 90s was followed by 6 years of the equal weight outperforming as the market broadened out. The largest stocks underperformed as valuations contracted. In 2022, we saw the average stock in the S&P 500 outperform. That year, value and small caps also significantly outperformed longer duration and large cap. market caps in general. On the next slide, we have two charts highlighting how valuations look very attractive today in small caps. The chart, the upper right, highlights top 5 stocks versus the total Russell 2000 index. Top 5 stocks are more than 28% of the S&P 500. The dark line on that chart highlights the top 5 stocks are now more than 5 times the size of the entire Russell 2000. Prior to 2018, the ratio would fluctuate between 1 and 2 times. The red line highlights the price to sales. The last 25 years, it's typically been 1.5 to 2.5 times. However, today it's not far from the historical extremes, near 6 times. On the bottom chart, it looks at the next 12 months relative P multiple between small caps and large caps. Not surprising, small caps ended the year nearly 2 standard deviations below large caps. It's very similar to the 2000 time period. Small cap valuations are even more extreme if you were to look at other valuation multiples, whether it's price to cash flow, price to sales, or EV to EBITDA multiples. On the next slide, we highlight basically the rolling 10-year average relative returns between small caps and large caps. And we ended 2025 at the first decile when you go back over the past 100 years. Small caps have lagged large caps by approximately 6% annualized. And as you can see in the chart, the late 1990s, early 2000 was the last trough of similar nature. And going forward, small caps outperformed by 6% over the following 10 to 12 years. In addition, the chart on the bottom highlights how underowned small caps are in the market in general. Small caps as a percentage of total equity is below the 2000 trough. It's nearly half those levels. One would have to go back to the 1930s to find a lower time period. And again, looking up at the top chart, coming out of the 1930s, small caps 10-year annual relative performance outperformed large caps by 5 to 10%, looking out 10 to 15 years from that time period. On the next slide, we highlight what we're seeing, which is growing positive drivers for a meaningful small cap outperformance cycle. We highlighted earlier on this call that if you go back and look, interest rates going back to the 1950s, there's been 14 interest rate easing cycles. We're currently in the midst of one. Large caps tend to lead early on. However, after about 150 basis points of cut, or around about 12 months from the start of the interest rate easing cycle, small caps have historically outperformed. 15 months after, if you go back and look at those 14 occurrences, small caps on average were up over 35% versus 21% for large caps. Earnings are also re-accelerating for small caps. We're emerging from a 2-year earnings recession for that portion of the market. During this past quarter or third quarter, small cap earnings growth slightly exceeded large cap. It's the first time in more than 10 quarters, and consensus expectations are for that to continue 2026 and 2027. And relative valuations, as we walked through in the prior slide, are near historical extremes and remain very wide, favoring small caps. And then finally, deregulation, which continues across multiple industries, and also the $150 billion of stimulus from the upcoming tax cuts, we think provides tailwinds for small cap profitability and earnings growth. On the next slide, we walk through and highlight fourth quarter returns. We don't think this is widely highlighted or picked up in the market, but you saw a broadening and a nice rotation within the equity market. Value outperformed growth by 270 to 724 basis points, and that was across all market caps, as you can see on the slide. And that broadening and rotation has continued. While it's still early in the year, only 3 weeks in, value is again leading, and small caps are now up in excess of 8% through the end of today. And that's more than 1,000 basis points ahead of large cap growth, which is actually negative, down close to 2% for the year. So we think we're still in the early innings of a small cap and value outperformance cycle. And if we go to the final slide, here I want to just highlight, one name in particular, Gray Media. The symbol is GTN. It's currently trading at around $4.46 a share. The company is a leading local television station owner. 90% of their 100 plus stations are ranked number 1, number 2 in markets across the US. The market-leading share positions allows the company to disproportionately lead the industry for political revenue, in addition to organic growth. And then for this upcoming year, there's 28 of 35 Senate races, 30 of 38 governor races, and all of the House of Representative seats are up for re-election in Grace markets. Much larger number of races versus if you're compared to 2024. So the company appears to be well positioned, generate about 400 to 600 million plus of high margin political revenue there this year. That should help accelerate debt reduction. In addition, the industry has also started deregulation, which is underway with the FCC looking at rules that haven't been updated in excess of 25 years. Gray is waiting approval on small station acquisition swaps. And there's a potential to create, we think, 10 new market duopolies if these close. They're at attractive valuation multiples, and it's nicely accretive to the balance sheet. The absolute valuation is near historical trough, less than 2 times 2026 earnings. The market cap is near this year's expected free cash flow. And as you can see on the chart, which is it's a deep discount to current book value of the share price. And with the accelerated debt reduction this year, no debt maturities before December 2028. We'd also believe that the 2031 debt looks significantly mispriced. It's trading in the mid-70s, and we believe that's an attractive opportunity within the capital structure.